Welcome to ECO202 Study Session 3 National Income Accounting Introduction. In the previous study session, we discussed unemployment. Here, we will explore basic concepts and computations in national income accounting and examine how to determine national income. Learning outcomes. When you have studied this session, you should be able to 1. Define and use correctly the following basic concepts often used in national income accounting, that is, national income, gross domestic product, gross national product, net national product, personal income, disposable income. Then 2. Point out major limitations to using GNP and GMP as a measure of welfare. 3. Compute national income accounting. 4. Calculating nominal and real GDP. And 5. Determine national income. A review of gross domestic product and gross national product. We noted in ECO202 Study Session 2, gross domestic product measures the value of output produced by factors of production in the domestic economy over a period of time, regardless of those who own these factors. Again, you will recollect that the concept of GDP is a flow. It measures output at a particular time. For the purpose of computation, we recognize final goods and services. This is to avoid the problem of double counting and unnecessary aggregation of the value of goods and services produced. In addition, GDP only takes into cognizance payments earned as a result of only goods and services produced, while payments not made in respect of produced goods and services are not counted. Such unaccounted payments are known as transfer payments. When GNP is measured at current money value, its value is going to be affected by the price level. It is possible for the value of GNP to double between 2 years, but this does not imply that welfare level has increased. If the price level also doubles over the 2 years, then the value of GNP has not changed in the 2 years. Thus, when GNP is valued at the current price level, it is referred to as nominal or GNP at current prices. On the other hand, GNP, which has been corrected for changes in the price level, is called GNP at real prices, or alternatively as real GNP. It is the actual measure of changes in welfare level over a given period. Definitions of the relevant concepts. National income. This is the total amount paid to factors of production, that is, land, labor, capital, and entrepreneur. It is derived from GNP by subtracting from the latter indirect business taxes and depreciation. Gross domestic product. This is the monetary value of goods and services produced in an economy, irrespective of the nationality of those who produce them over a given period of time, usually a year. GNP, gross national product. This is the monetary value of goods and services produced by the nationals of a country, whether resident within or outside the country. It is simply GDP plus income from abroad, that is, income earned by nationals of the country resident abroad, minus income of foreigners residing within the country. Net national product, NNP. This is GNP minus depreciation. It is the value of national product after making allowances for depreciation of the capital used to produce the output. Personal income. This is the total amount an average individual receives as income. It differs from national income in two ways. First, some people who have a claim on income do not actually receive it. For example, although all the profit of a firm belong to the owner, not all of this is eventually paid out to them. Second, some people receive income that is not obtained in exchange for services rendered. To reconcile personal income and national income, you subtract corporate profit from national income and add dividend to the result. Then you must deduct contributions for social insurance and add government and business transfer payments. Disposable income. This is simply the take-home pay for workers. It means the actual income which can be spent on consumption of individuals and families. The whole of the personal cannot be spent on consumption because it is the income that accrues before direct taxes have actually been paid. Therefore, in order to obtain the disposable income, direct taxes are deducted from personal income. Thus, disposable income equals personal income less direct taxes. Measuring GNP. There are three basic approaches to measuring GNP. They are 1. Expenditure approach, 2. Income approach, 3. Output approach. We shall examine the above approaches serially. The expenditure approach. It involves adding together all the expenditure on final goods and services. Economists distinguish among four categories of expenditure. 1. Personal consumption expenditure. These include the spending by households on durable goods, non-durable goods, and services. Personal consumption expenditure usually accounts for the greatest proportion of total expenditure. 2. Gross private domestic investment. This consists of all investments spent by firms in the economy. Three broad types of expenditure are included in this category. 1. All final purchases of tools, equipment, and machinery. 2. All construction expenditures, including expenditure on residential houses. And 3. The changes in total inventories. Number 3 now, government purchases of goods and services. This includes the expenditure of the federal, state, and local governments in the performance of their functions. However, it excludes transfer payments since they do not arise from production processes. 4. Net export. This is simply the difference between the country's export and import. Using the expenditure approach, GNP can be summarized as GNP equals personal consumption expenditure plus gross private domestic investment plus government purchases of goods and services plus net export. The income approach. To use this approach, we simply sum up all the incomes earned by factors of production, that is land, labor, capital, and entrepreneur, for their contributions to the production of the year's output. This income is of various types. They are 1. Compensation of employees. This is the largest of the income categories. It includes the wages and salaries that are paid by firms and government agencies to suppliers of labor. In addition, it comprises of a variety of supplementary payments by employers for the benefit of their employees, such as payment into public and private pension schemes and welfare funds. 2. Rent. In the present context, Rent is defined as payment to households for the supply of property resources. For example, it includes house rent received by landlords. 3. Interest. This includes payment of money by enterprises to suppliers of money capital, interest paid by the government on treasury bills, savings, bonds, and other securities are excluded on the ground that they are not payment for current goods and services. They are regarded as transfer payments. 4. Proprietor's income. This consists of net income of unincorporated businesses. In other words, it consists of the net income of sole proprietorships and partnerships. 5. Corporate profit. This is the net income of corporations. This is made up of 3 parts. 1. Dividend received by stockholders. 2. Retained earnings. And 3. The amount paid by corporations as income taxes. All the items discussed above are forms of income. In addition, there are 2 non-income items, depreciation and indirect business taxes, that must be added to the sum of income items to obtain GNP. On the basis of income approach, GNP, where the income approach can be summarized as compensation of employees plus rent plus interest plus proprietor's income plus corporate profit plus depreciation plus indirect business taxes. 3. The output or value added approach. This is simply the monetary value of all value added to every sector in the economy. In other words, it is the monetary value of the contributions of all the outputs of goods and services by various sectors in the economy. It should be noted that the emphasis is on value added. Value added is the amount of value added by a firm or industry to the total worth of the product. Limitations of GNP and NNP. There are certain limitations in the use of GNP and NNP as measures of economic well-being or for the purpose of international comparison of well-being. Some of these limitations are population. GNP and NNP are not very meaningful unless one knows the size of population of the country in question. For instance, a country's GNP may be $50 billion, but have a population of 500 million, while another country may have 20 billion, but with a population of 10 million. Clearly, the second country, though with a smaller GNP, has a higher standard of living. To make inter-country comparison more meaningful, per capita income, GNP derived by the population is often used. Leisure. GNP and NNP do not take into account leisure. Usually, as people become more affluent, they substitute leisure for increased production. Yet, this increase in leisure time, which contributes to increased well-being, does not show up in GNP and NNP. Neither do the personal satisfaction or displeasure people get from their jobs. Quality changes. GNP and NNP do not take into account changes in the quality of goods unless its price reflects the improvement. For example, for a brand new type of drug, if the output and cost of the new drug is the same as the old, the GNP will not increase, even though the new drug is twice as effective as the old. 4. Value and distribution. Both GNP and NNP say nothing about the social desirability of the composition and distribution of the nation's output. Each good and service produced is valued at its price. If the price of a Bible is 100 naira and that of a pornographic book is 100 naira, both are valued at 100 naira each and entered into the GMP competition without revealing their relative importance. The two measures do not reveal how the two goods and services produced are distributed in the society. Are they evenly distributed or distributed in favor of the rich? GMP is silent on these questions. 5. Social cost. GMP and NNP do not reflect some of the social costs arising from the production of goods and services. In particular, they do not reflect environmental costs of production activities. Calculating nominal and real GDP. Nominal GDP, this is simply the sum of the quantities of final goods produced times their current prices. A warning is in order here. People often use the word nominal to denote small amounts. Economists use nominal for variables expressed in units of the currency of the relevant country. Nominal GDP increases over time for two reasons. The first is that the production of most goods increases over time. The second is that naira price of most goods also increase over time. We produce more and more goods each year and their naira prices increases each year as well. If our intention is to measure production and its change over time, we need to eliminate the effect of increasing prices. For this purpose, economists focus on real rather than nominal GDP. To construct real GDP, we first choose a base year. We then construct real GDP in any year as the sum of quantities produced times their prices in the base year. An example would help here. Suppose that an economy produces two goods, potatoes and cars. In year 0, which we shall take as the base year, it produces 100,000 pounds of tomatoes and sell them at 100 naira a pound, and 10 cars that sells for 400,000 naira a car. 1 year later, in year 1, it produces and sells 100,000 pounds of tomato at the price of 120 naira a pound and 11 cars at 400,000 a car. Nominal GDP in year 0, base year, is thus equal to 5 million, and nominal GDP in year 1 is equal to 230,000 naira. This information is summarized in table 3.1. The increase in GDP nominal from year 0 to year 1 is equal to 2.4 million naira divided by 14 million naira, which is equal to 17%. But what is the increase in real GDP? Let us take year 0 as the base year. That is, let's add quantities in both year 0 and 1 using year 0 prices for tomatoes and cars. Because we take year 0 as a base year, real GDP is equal to nominal GDP in base year. Real and nominal GDP are always equal in the base year. In year 1, real GDP is constructed by using year 1 quantities times year 0 prices, so that it is equal to 100,000 times 100 naira plus 11 times 400,000 naira, which gives us a total of 14,400,000 naira. The increase in real GDP is therefore equal to 400,000 divided by 14 million, or 2.86%. Instead of using year 0 as a base year, we could have used year 1 or indeed any other year. The choice of the base year would typically affect the measure of real GDP growth. For example, if we had used year 1 as the base year, real GDP for year 0 would have been equal to 100,000 times 120 naira plus 10 times 400,000, which would have given us 16 million naira. By construction, real and nominal GDP will be the same in year 1, both equal to 16,400,000. The increase in the real GDP will be equal to 400,000 over 16 million, thus 2.5%. It will thus be a smaller level of increase in GDP that we will obtain using year 0 as a base year. Determination of national income. In most countries today, an examination of the country's GNP for various years will show the fluctuations which take place in these countries. A period of rising GNP followed by another period of declining GNP, and so on. However, these fluctuations cause serious strains on the economy. In this section, we will highlight why fluctuations. In addition, we will explore how to determine national income in various types of economies. The circular flow of income. The circular flow of income shows transactions between the agents in the economy. For instance, in a closed economy, if we assume that there are two economic agents, that is, households and firms, this circular flow of income in that economy can be depicted as follows. In the above economy, firms purchase factors of production from the households, and for these they pay incomes to the household. This first part of the relationship is depicted by the inner flows in the figure above. On its own part, the households buy goods and services from the firms, and for these they make payment to the firms. Since we assume that there is no leakage in the economy, then all sides of the transaction must be equal. This means that the income earned by household must be equal to the value of output produced by firms. However, if we introduce leakages and injections into the circular flows of income via savings and investment, then the circular flow of income would be altered as illustrated in figure 3.2. In the economy illustrated above, we assume that households do not spend all their income on current consumptions of goods and services, but save part of it. The amount saved then constitutes a leakage from the system. On the other side, firms do not sell all their output to households. Some are investment goods. This represents an injection into the circular flow. All injections is an addition to the income of domestic firms, which does not arise from expenditure of households, or an addition to the income of household that does not arise from the sale of factor services to the firms. Components of aggregate demand. In a closed economy and in the absence of government, there are two sources of demand. They are consumption demand and investment demand. This is represented as aggregate demand equals C plus I, that is consumption plus investment, where AD is aggregate demand, C is consumption, and I is investment. A. Consumption demand. This is the total amount of money spent by households on goods and services consumed in the economy. Such goods and services ranges from cars and food to theater performances and electricity. These consumption purchases account for the highest proportion of aggregate demand. B. Investment demand. This consists of firms' desired or planned additions to boost their physical capital, that is factories and machines, and to their inventories. Inventories are goods being held for future production or sale. Aggregate demand can be illustrated by the following diagram. Case A. Equilibrium national income in a closed economy without the government. Earlier on in this study session, we introduced injections in form of investment and withdrawal via savings into the circular flow of income in a closed economy. The two, however, carried out by different agents in the economy. However, in such an economy, equilibrium national income occurs where savings equal investment, that is, withdrawal equals injection. When savings exceed investment, income falls. This will lead to a reduction in the household savings, and this will continue until the two are equal. The opposite holds when investment exceeds savings. The equality between savings and investment could be demonstrated either statistically or graphically. Statistically, national income Y is equal to consumption expenditure C plus investment expenditure R. That is, Y equals C plus R. And from that, we can make I the subject of the formula and say I equals Y minus C. But we know that income minus consumption is equal to savings. Therefore, equation 2 can be written as I equals S. That is, investment equals savings. Geometrically, this equation can also be shown as follows. In the figure above, savings and investment are equal when investment is 20 million. The equilibrium national income at this point is 100 million. The investment curve is a horizontal line because we assume it is exogenously determined, that is, fixed irrespective of the level of national income. On the other hand, the savings function is an upward straight line because we assume saving to be a fixed proportion of a given level of income. The income expenditure approach. This is another graphical method for showing the equilibrium level of national income. This is illustrated below. The 45-degree line shows the equality between actual expenditure and actual income. Points above or below the line shows a combination from which expenditure exceeds income or expenditure is less than income respectively. In this figure, the equilibrium level of income is determined at the point of interaction of aggregate expenditure function and the 45-degree line. At this point, the aggregate demand will just be sufficient to buy up the total of goods produced. Any other point leads to disequilibrium. Case 2. Equilibrium national income in a closed economy, but with the presence of government. At this junction, we recognize the presence of the third economic agent, the government, in our analysis. The introduction of government into the economy brings into our analysis another type of withdrawal variable, that is taxes, an injection variable, that is government expenditure. The introduction of these variables, however, did not alter the basic conditions for equilibrium in the economy. The equilibrium condition still requires the equality of total withdrawals and total injection. Thus, the equilibrium condition in this economy can be statistically stated as injection equals withdrawal, or investment plus government expenditure equals savings and tax. The income expenditure approach in this economy will now alter the components of our aggregate demand by now including government expenditure. Thus, aggregate demand AD equals C, consumption, plus I, investment, plus government expenditure. National income will be in equilibrium if aggregate desired expenditure is equal to national income, because in that case, desired purchases will be exactly equal to total production. Case C, equilibrium national income in the open economy. We now relax our assumptions of a closed economy by allowing for the influence of foreign trade, that is, imports and exports. The introduction of imports and exports introduces additional variables into our analysis. We now have new forms of withdrawal, that is, import, and another injection, which is export. Import constitutes a withdrawal because money spent on import goes out of the economy and hence constitute a leakage to the system. On the other hand, export constitutes an injection into the economy from the sale of export. Equilibrium in terms of withdrawal and injection. Again, we assume that, like other previous injection, export X is fixed, while import, like other withdrawal, is allowed to change proportionally with income. The resulting equilibrium is shown below. If withdrawals are less than injection, there will be a net expansionary force in the economy. Income will rise. This will also make tax, savings, and imports rise. The expansion will come to a halt when total withdrawals have risen to the level of total injections and vice versa. National income will be in equilibrium when total desired withdrawals equal total desired injection. Thus, the equilibrium condition is, once again, W equals R. That is, savings plus tax plus imports equals investment plus government expenditure plus export. 2. An income expenditure approach in an economy. In an open economy, aggregate expenditure includes expenditure by foreign firms, households, and governments on domestically produced goods and services. This implies that aggregate expenditure includes export values. At the same time, some consumption expenditure made by domestic household firms and some government expenditure may go to purchase goods and services produced in foreign countries. Hence, import values must be excluded from aggregate expenditure. Thus, we'll have aggregate expenditure AD equals C plus I plus G plus X minus M. Once again, national income will be in equilibrium when aggregate desired expenditure is equal to total national income. When this is true, total desired purchases will just be equal to total production. Study session summary. In this study session, you explored the main concepts commonly applied in national income accounting. National income is simply the total income earned by all factors of production over a period of time, usually a year. There are 3 basic approaches to measuring GNP. These include the expenditure approach, the income approach, and the output approach. You were further told that The three approaches would give the same value for national income after making appropriate adjustments. In the course of this study session, you also learn how equilibrium levels of national income are determined in different economic systems. The equilibrium conditions in all these different economic systems are basically the same. These equilibrium conditions require that the total withdrawals in the economy must be equal to the total injections into the economy, and that geographically the equilibrium level of income determined at that point at which aggregate expenditure functions intercept the 45-degree. This is the end of study session 3. Thanks for listening.